SoFi stock, the AI bank Wall Street still doesn't trust. SoFi just delivered record numbers. Adjusted revenue crossed $1.1 billion in a single quarter. Loan originations hit $12.2 billion. Members grew to 14.7 million. And now SoFi is adding AI financial coaching and a stablecoin directly inside its app. But here is the strange part. After those numbers, the stock still fell. So the real question is not, is SoFi growing? It clearly is. The real question is this: is SoFi becoming the next generation digital bank, or is Wall Street correctly pricing in hidden risk? Before we go deeper, this is not financial advice. This video is for research and education only. Always do your own due diligence. Let's start with why SoFi matters right now. SoFi, it's not just another fintech stock. It sits at the intersection of lending, digital banking, investing, artificial intelligence, and now stablecoins. That combination gives it a powerful story, but it also makes the stock difficult to value. Traditional bank investors look at SoFi and see credit risk. Growth investors look at SoFi and see a digital banking super app. Crypto investors look at SoFiUSD and see blockchain optionality. AI investors look at SoFi Coach and see a possible new engagement layer. That is why the stock is so controversial. Different investors are valuing different versions of the same company. So what is SoFi today? SoFi originally became known for student loan refinancing, but that old version of the company is no longer enough to explain the investment case. Today, SoFi operates across three major areas. First, lending. Second, financial services. Third, its technology platform. The lending business includes personal loans, student loans, and home loans. The financial services business includes banking, investing, credit cards, deposits, and other consumer financial products. And the technology platform includes infrastructure from Galileo and related services that help other companies deliver financial products. The strategy is simple: acquire one customer, offer that customer multiple products, increase engagement, cross-sell over time, and eventually turn SoFi into the main financial operating system for that customer. That is the bull case, but the risk is also clear. If the customer is acquired cheaply, stays for years, and uses more products, SoFi becomes a powerful platform. If credit losses rise, funding gets more expensive, or customers do not adopt enough products, SoFi becomes a much more ordinary lending business. Now let's look at the latest quarter. In Q1 2026, SoFi reported adjusted revenue of about $1.1 billion. That was up 41% year over year. Earnings per share doubled to 12 cents. Total loan originations reached a record $12.2 billion. Members increased 35% year over year to 14.7 million. Net interest income rose 39% to $693 million, and fee-based revenue increased 23% to about $386.8 million.
On the surface, this was a very strong quarter. So why did the stock fall? Because the market was expecting management to raise guidance. Instead, SoFi kept its 2026 outlook largely unchanged. The company still expects about $4.66 billion in revenue and 60 cents of EPS for the full year. That is the tension. The numbers were strong, but expectations were even stronger. And with high-growth stocks, sometimes a good quarter is not enough. Now let's break down the lending engine. SoFi's lending business is still the center of the company. In Q1, total loan originations reached $12.2 billion. That included strong demand across personal loans, student loans, and home loans. This matters because lending gives SoFi scale and profitability, but it also creates cyclicality. When consumers are healthy, lending growth can look very attractive, but if unemployment rises, delinquencies increase, or credit markets tighten, the same lending engine can become a source of risk. This is why investors should not only ask, how fast is SoFi growing? They should also ask, how durable is that growth across a full credit cycle? Now, another key area to watch is the loan platform business. SoFi has been working with partners who buy or fund loans. This can help the company generate volume without keeping every loan on its own balance sheet. That model can improve capital efficiency, but it also depends on investor demand for those loans. If private credit buyers pull back, SoFi may face pressure on loan sale economics. That is one reason the market reacted cautiously, even after record originations. Now let's move to the new AI catalyst. SoFi recently launched SoFi Coach. This is an AI-powered financial coaching tool, initially available through SoFi Plus, the company's $10 per month subscription service. The tool is designed to help users understand spending, manage debt, track recurring expenses, and plan financial goals. It can also connect with external financial accounts to provide more personalized insights. This is important because AI could increase user engagement. More engagement can lead to more deposits, more product adoption, and better retention. But we need to be careful. An AI feature is not automatically a profit engine. The key question is whether SoFi Coach becomes a true monetization layer, or whether it remains a nice feature that does not materially change the economics of the business. Also, SoFi Coach does not currently take actions on behalf of users. It also does not provide investment advice. So this is not yet a full AI financial advisor. It is better understood as an engagement and guidance tool. Now comes the most interesting optionality, SoFiUSD. SoFi has made its stablecoin available directly inside the SoFi app. Nearly 15 million users can now buy, sell, and hold SoFiUSD. The stablecoin is available on public blockchain networks, including Ethereum and Solana. Its current market cap is still small, around $100 million. That compares with the total stablecoin market of roughly $318 billion. So this is not yet a large revenue driver, but strategically it matters. SoFi is trying to connect traditional banking with blockchain-based payments. The long-term idea could include faster settlement, international transfers, tokenized deposits, and deeper crypto engagement inside a regulated banking app. That creates upside, but it also creates risk. Stablecoins are still politically sensitive, regulation can change, consumer adoption is uncertain, and competition is intense. So for now, SoFiUSD should be viewed as optionality, not as the core valuation driver.
Now let's compare SoFi with its fintech peers. Upstart is an AI-driven lending platform. It is more focused on using artificial intelligence to underwrite loans. Its latest first-quarter revenue was about $308 million, up 44% year-over-year. But the company still reported a net loss, and investors were disappointed by profitability. Affirm is different. Affirm is a buy-now-pay-later leader. Its strength is merchant distribution, consumer checkout behavior, and the Affirm card. It has tens of millions of active consumers and strong gross merchandise volume. But the risk is tied to consumer credit, merchant growth, and the economics of buy now, pay later. Robinhood is different again. Robinhood is strongest in trading, investing, crypto, options, and assets under custody. It has more funded customers than SoFi and a much larger base of customer assets. But Robinhood is not trying to be a full digital bank in the same way SoFi is. SoFi sits in the middle. It is not the purest AI lending company, it is not the biggest trading platform, and it is not the biggest buy now, pay later network. Its advantage is integration. Banking, lending, investing, AI guidance, crypto, and financial services in one app. Its risk is complexity. Investors have to understand several businesses at the same time. Now let's build the bull case. The first part of the bull case is member growth. 14.7 million members give SoFi a large base to monetize. The second part is cross-selling. If SoFi can sell more products to existing members, revenue per customer can rise without equally increasing acquisition costs. The third part is fee-based revenue. If fee revenue grows faster, SoFi becomes less dependent on net interest income and lending cycles. The fourth part is AI. If SoFi Coach increases engagement and retention, it could become a meaningful advantage. The fifth part is stablecoin optionality.
If SoFiUSD becomes useful for payments, transfers, tokenized deposits, or crypto engagement, the market may start valuing SoFi as more than a lender. That is the optimistic view. SoFi becomes a profitable digital financial platform with sticky users, AI-driven engagement, and blockchain payment optionality. Now, the bear case. First, lending risk is real. SoFi still depends heavily on consumer credit. If the economy weakens, credit performance can deteriorate. Second, valuation risk is real. When a stock has a strong growth story, expectations become very high. A good quarter can still disappoint if investors expected an even better one. Third, guidance matters. The company did not raise full-year guidance after a strong Q1. That may simply be conservatism, but it may also signal that management sees uncertainty ahead. Fourth, stablecoin adoption is not guaranteed. Consumers may not use SoFiUSD at scale. And fifth, AI monetization is still unproven. SoFi Coach sounds promising, but investors need evidence that it changes behavior, retention, or revenue. So, here is my framework. Growth? Strong. SoFi is growing revenue, members, products, and originations at an impressive pace. Durability? Improving but not fully proven. Fee revenue, AI, and stablecoins help the platform story, but lending remains central. Risk is still high. Credit cycles, valuation, guidance, and product execution all matter. So my final take is this. SoFi deserves attention, but not because it is a guaranteed winner. It deserves attention because the market is still debating what kind of company it really is. If SoFi becomes a profitable digital financial platform with sticky users, AI-driven engagement, and blockchain payment optionality, today's skepticism could become an opportunity. But if credit conditions weaken, loan sale demand fades, or new products fail to monetize, SoFi could trade more like a cyclical lender than a technology platform. So, the key question for investors is not, will SoFi grow? The key question is, how much of that growth is durable, profitable, and worth paying for? That's the question I'll keep tracking. If you want more deep dive stock analysis without the hype, subscribe to Daily Filter Investing. And tell me in the comments, is SoFi an AI-powered digital bank or still just a risky lending stock?